You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com. You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Whether you want to learn how to protect your portfolio, generate income, or even become a master of volatility, the Options Bootcamp drill instructors will break it all down for you. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors.
All right, everybody. That music means we are back once again on the network. It's Education Wednesday, listeners. That can mean but one thing. It is time for a little bit of the old Options Bootcamp. My name, of course, Mark Longo from the THE, optionsinsider.com, as well as from the network with the same name, upon which so many of you folks are mainlining these days. And usually this is where I introduce my cohort and I talk about our listeners out there, but they're kind of wrapped up one and the same this week in terms of listener reviews and all that fun. Because first off, I am not joined by my usual compatriot, the black-hatted one himself, Mr. Dan Passarelli from Market Taker Mentoring, because he is traveling abroad. But I am joined once again. He has popped on the show a few times. Pleased to welcome him back. Mr. Matt Amberson, the founder over there at ORATS, a.k.a. Options Research and Technology Services. We call him around here the Otto Father because he did create a rogue AI called Otto and also the Oracle of New Hampshire. Mr. Matt, welcome back to the old Options Bootcamp Drill Instructor Proving Ground, sir.
It's great to be here. Great to be on a show like this. I wish I would have had it when I was learning options way back in the day. It was trial by fire, and some firms had pretty good training camps, but it was trial by fire for the independents that went down there to the floor and learn. I traded options before I got to the floor too, but it's great to be on a show like this, Mark.
Yeah, it would have made things easier. I was fortunate. I had a firm that had a pretty decent investment in training. They brought in guest speakers and all kinds of stuff. That was kind of fun. But you're right, a podcast you can listen to at your leisure. First off, the technology didn't exist, but it would have been nice to have RSS on-demand options learning. Back then, you had to just crack the old Natenberg Bible and go for it at the end of the day. But I mentioned at the top of the show, we're kind of combining a few things here. Usually we do a 5-star review from a listener. But, Matt, it's kind of rote. It's kind of cliche to say, oh, we have the best audience ever. We love you folks. Everybody on social media, everybody on YouTube, everybody with a podcast, they all say that. So I try to avoid trotting that out. But in our case, Matt, it literally is true. We have the best audience on the planet. I've been saying that for 16 plus years now. You folks are still just as awesome and getting better all the time. I got stopped by a listener earlier this week. They wanted to talk all about the 80s wrestling segment we do on the Monday show. So I always love to see what resonates with you folks. And then, of course, the listeners of this fine program, Options Bootcamp. You folks also take it to another level. Matt, we had a listener write into the show earlier in the year. I think it was back in February. His name was Ali John Elgin, saying he lived out of Frankfurt in Germany, but he had some options questions. And he also said if we're ever in town, he would take us around Oktoberfest if we ever made it to his neck of the woods. Well, guess where my compatriot, Mr. Dan, the black-headed one, guess where he is right now, Matt?
Wow. If he's there, I'm very jealous.
He literally sent me a picture right before showtime about an hour ago of him actually posing with Ollie John. So they did meet up there in Munich, and they're in a beer hall. No lederhosen, though. I'm a little bit disappointed by that. But he did meet up. So our listener following through with his offer to chauffeur Dan around Oktoberfest and give him a locals lay of the land. So we do truly have a global audience. And, they're just great people at the end of the day, Matt, which is awesome. It makes doing this show that much more fun, Matt.
Yeah, I did end up going to Munich for the first time last month. So I did meet up with some of my clients out there in Germany, Switzerland, and Austria. And I could tell you, my wife and I have never laughed so hard as in the beer haus, the big halls of beer. It's a great scene. Everyone kind of family table sits together, and it's a lot of fun. So Dan, no doubt, is having a great time.
Yeah, looking at this picture, they're having a good time. Again, all they're missing is the lederhosen. So yeah, they're off drinking in a beer hall while we're doing the show. So I guess who are the schmucks in this scenario, Matt?
Well, we got to do it. We got to teach.
Yes,
so let's do it.
Yes, while they're drinking, the rest of us need to hold court for a little bit of the old basic training.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out. Do you hear me? Yes, sir. Basic to complex. Yes, sir. There will be no failures. Do you hear me? Yes, sir. Pull in. Yes, sir. Prepare to learn. Yes, sir.
All right, everybody, time to put on your drill instructor hat and your whistle because it is time for a little bit of the old basic training. Today, we're diving into a strategy we haven't really spent a lot of time on the show. It's got two different moving parts, two individual components, and those two we have discussed quite a bit on the show, but we don't really put the two together in a package. That's what we're going to talk about today. What is this strategy, this mystery technique, this bit of options wizardry called? Well, it's got many names. If you want to be boring, some folks just call it the wheel. Some folks call it the wheel of fun. Our old buddy, Mr. Tusaw on the option block, he calls it the triple income strategy. But let's jazz it up even farther, Matt. How about something catchy? How about the wheel of death? How does that sound to you, Matt?
Yeah. No.
Get on the wheel of death. However way it turns, you lose. What about that, Matt? Does that sound? Would you want to trade that option strategy, the wheel of death?
Still no.
No? You're out on the wheel of death. I guarantee if you put it up as a podcast title, folks will be intrigued by the wheel of death. So it does have its utility. But I know, speaking of wheels, sir, I know you've been all about the wheel these days as well. For all the different strategies you guys are analyzing and crunching the numbers over there at ORATS, you've kind of come back to the wheel, pun intended out there. So I'm curious, what is it about the wheel that you find so attractive? Why did you gravitate towards the wheel in this environment?
Yeah, no, you're right. So what we did is we started back testing it now. We've got the back tester to a point where we could handle it. It's pretty complex. I mean, it may not sound too complex, but there are a few moving parts that you have to do in order to back test it. So we started back testing it. And then I kind of came up with my own flavor. At least I call it my own. It's, being an old market maker, I never like to be short naked puts. So I do a put diagonal for a credit. So I'm essentially selling a pretty meaty put, buying a farther dated, smaller put. And that's how I start the wheel process. So I've really enjoyed it. And the funny thing about using that type of wheel is that if it goes up, you make it because you've done it for a credit, and if it goes down and it just goes down to the short strike, that's probably the best outcome you could get. So you kind of have it both ways, and then if it goes down there and you get assigned, and you have a stock and you have a put, and then you can start selling calls. I've really enjoyed it. Some of the back tests, just the straighten wheel where you start with a selling a put and then you get a sign and get the call. Some of those back tests have looked pretty good. So I've been enjoying doing the wheel more. I honestly hadn't done it a whole lot before that, so I'm a new convert, Mark.
That sounds like an awesome approach to the Wheel of Death. Congratulations, sir. Okay, Matt's talking about the 201 or the 301 version. Let's start with the basics, and then we'll kind of accelerate from there, listener. So what is this wheel of fun, triple income, call it whatever the hell you want. There are many different names for this. There's really two moving parts to it. Or in the case of Matt's, he's got like 6, but we'll get there in a second. Let's start with the basic, the first step you're going to take when starting your wheel. You have an underlying, everybody loves XYZ. In our case, XYZ, trading for around $100. And we're going to look at it and say, maybe you're looking at it, maybe your client's looking at it, if you're an advisor, whatever the case may be. You're interested in maybe buying the stock if it drops $10 down to 90 over the next, let's say, month. In our example, keep everything nice and easy and straightforward. You can do a bunch of different things. Obviously, you can work the limit order to buy the stock. We talked about that many times on the network in the past. You're taking risks, not really getting compensated for it. You're much better off getting compensated for that risk. So in our example, instead, you sell a 1-month put on the 90 strike. You sell a 10 locks. You want to buy 1,000 shares. You're getting big. You're swinging for size here on this one. So you know the math. We've talked about cash secured puts many times on the network in the past. If you've missed any of those, go back to literally any of the archive episodes. We talk about them many times. Of course, you're going to sell 10 contracts. You're going to collect $1. So 10 times 100 times $1, it's $1,000 in your pocket for doing this. If the stock drops, of course, you get the stock put to you at an effective price of $89, $90 minus the $1 you collected. All very straightforward, all what we talked about a million times. So you might say to yourself, hey, that's just a short put. What is this wheel thing? This wheel of death, wheel of fun, call it what you will. What the hell is this thing? So let's fast forward a little bit. So you sell this put, and maybe you do it the first couple of times, and nothing happens. You just keep your $1,000 over and over again, rinse and repeat. XYZ kind of vacillates around the 100 level, never moves. So that's not a bad outcome. You're getting paid for that. It's a nice little income stream you've created. Now let's say maybe a couple of months in, XYZ hasn't really moved. You sell that same put again for the same level, and now the stock drops. Now the stock drops to below 90 at expiration. So you get the stock put to you right around 90. Let's say, for sake of our example, the stock's hovering right around 90. Just crosses it just enough to get those puts auto-exercised, which is, again, a great deal because you sold that put for $1, so you bought it for 89. Now you own the stock. It's hovering around 90 along 1,000 shares. Now you have some questions to answer for yourself. What do you want to do with this thing? And now if you put this on with the intention of maybe wheeling it to begin with, the answer is, you know what? I might want to wheel to get back out of it. And that's where the second leg, the other half of the wheel, really comes around. You look back at the stock and say, you know what? If it rallies back up to where it was, back up to $100, I wouldn't mind letting the stock go again. So in our example, you now turn around and you sell a covered call at the 100 strike. In our example, you get $1 again. So it's pretty much the exact same trade. You collect $1,000, stock's hanging out at $90, and now a couple of things could happen. The stock languishes around 90, or maybe it drops below 90 and continues to drop at expiration. Well, guess what? You're not getting the stock called away, and you're going to keep the $1 or $1,000, and you're free to rinse and repeat and do this strategy again month after month at whatever level you're comfortable with, depending on where the stock is around expiration. Or the stock rallies over 100 by expiration. Now, guess what? You're selling your stock at an effective price of 101 because you collected $1 for it. So you did it on 1,000 shares. So you're doing a 10 lot. So you're making $11,000 in this example. So you got 10,000 from the appreciation on the stock, 10 points on 1,000 shares. And then, of course, the extra $1,000 kicker on the wheel. And now what happens at the end of 2 months? You're now flat again. You have no position. You have this nice little chunk of change in your back pocket that you've made here. And now you've wheeled out of it. And the trade can be done. You could move on to other underlyings, or you could decide, you know what, I like that. I think this name maybe is a little bit range bound for the future. Maybe I want to dive in and wheel again. So it's up to you. You can rinse and repeat. You could roll on, pun intended, again, with the wheel. That's why a lot of people like this strategy. It's relatively finite in nature. It allows you to have a lot of flexibility on both the entry point and the exit point. It really is conducive to the way a lot of people like to approach using options in conjunction with stock. All right, so there's your basic setup for the wheel. But as you heard Mr. Matt allude to at the onset of this segment there, he's turning it up a notch. He's turning it up to 11. So now, Mr. Matt, I kind of broke down the basic version, selling an out-of-the-money put, getting the stock put to you, turning around, selling the out-of-the-money call, getting the stock taken away. That's your basic flavor of the wheel. But you're jazzing it up a little bit. Walk us through your version and why you decided to add these upgrades.
Yeah, well, first of all, that is the way to do it, and we've back tested a bunch just of the normal straightforward wheel strategy. So what we do is we set up the put, so the put gets a delta, and then we also back test the call kind of separately, or as a team, I guess. But so there's all these teams that we back test. So you might have a 45-day short put that's 10 delta, and then if it gets put to you, then you might sell a 30 days to expiration 40 delta call. So we've tested all those variations, and what we tend to find is that the more out of the money put from a risk return basis, the out of the money put's better. And then the call is probably more in the money. So once you get the stock, be a little bit more aggressive on the call. So that's what we've kind of found in the testing. I'll just, and that's SPY. We have some other symbols as well. So, again, I think that's all well and good, but I don't like drawdowns like that. I don't like being short. Anything could happen in the market. As a market maker and someone that's been in the financial markets for longer than I'd like to admit, anything could happen out there. A lot of people trading in the market have never even seen a savage bear market. So I hate being short puts. So I added a farther out of the money long put, and still doing it for a credit, enough of a credit to make a difference. And but now I have protection, and like I said, if it goes up, if it goes down, either way is kind of fine with me, because with a put calendar, or in this case a put diagonal, if it goes down to that short strike and expires there, if it goes there, that's the best. If it keeps going down, of course, then you might want to think about managing it, or just accept the stock. There, you have a put, right? So if it goes wildly down, you have that decision to make now. So you might have two puts in the money. One still has some time to expiration. So that's been it takes the stress out for me. As you get older, and I've spent a lot of my trading stress on the floor. So I like to have it less stress. And, definitely in the last, couple of weeks, as the markets come down, that strategy hasn't been that great, but it's been much better than just short a put for, or cash secured put. I don't like that terminology necessarily, but I'm just looking over. I have 2, 4, 6, 8, 10, 12, 14, maybe 20 stocks I have with this strategy. I like to diversify stocks because, I like to diversify because, you never know what's going to happen with one and just holding one. But I'm actually up today with the market down, I don't know, about 0.5%. So, some of these still could do well. So those are the reasons that I've chosen a slightly different wheel strategy. First, seeing that the wheel can work in just straight back tests, and then throwing a kicker on there, and then I haven't it's been kind of a new thing for us. We just started the wheel a few months ago, so I haven't been assigned yet. So I'm still waiting for that. So those are the reasons, Mark.
Interesting stuff. In your analysis, does let's call it the upgraded version, your 2.0 wheel of death, does it outperform the traditional, or is it more, I know you like to talk about Sharp and Sortino and kind of the risk-adjusted basis. Is it more along the lines of what you mentioned, kind of a little bit more ease of sleeping at night, sir?
Yeah, I mean, honestly, we haven't. We are programming it in, as you mentioned. It does have a couple other moving parts. So my team, Auto included, are working nights to get this done. But we haven't back tested it. So, but you ask it, how has it performed? It's definitely outperformed in this market. Those small out of the money puts have kicked in, and the out of the money puts that were that were sold, some of them haven't been breached or been breached by a short amount, so they're almost at the perfect spot. So definitely, it's outperformed. I watched some other YouTube videos on in my research for what people are doing out there. They're having some challenging times right now with their wheel strategies. Just again, the euphemism cash secure put, but that's just a short put, and they're seeing some drawdowns, and whereas this strategy, the drawdowns aren't that great, and some of them are, if they sit there, they could actually, like I said, be at the pinnacle of the payoff diagram. So yeah, it's working. It's working, and it's been a bad market. So I'm not profitable yet, but I expect to be as these things start to expire. And right now a lot of the puts are near the strike and the short strike. Still, the long strike is still below that, and the longer dated. So I expect it to be. And like I said, I started them all for credits. So I have the credit, and then I have the decay now, and we'll see. We'll see how things transpire, Mark.
But Matt, it's a cash secured put. What can go wrong? It sounds so safe.
Yeah, exactly. And cash doesn't have any curvature to it, unfortunately. But yeah, I've never liked that terminology. I remember when people started talking about that. I'm just like, come on, guys. But me, Mark. I've been bearish the market for a while, and so this is kind of my long that I hold against some of my out of the money put calendars. And so the whole thing's working. Let's just say.
We'll get to your bearish outlook in a second. But yes, listen, there's a lot of power in a name, whether it's the cash secured put or maybe whatever we end up calling this strategy. What do you like, listeners? You like Wheel of Death, Wheel of Fun, triple income strategy, just the wheel? Let us know. What do you call this strategy? If you trade it, are you intrigued by this? Does this fit in with your parameters of how you like to use options? I'm very curious. You don't have to just write in if you're drinking in a beer hall with Dan in Germany. You could write in all sorts of fun. Speaking of your thoughts, it's time to get those right now. Time for a little bit of the old mail call.
Mail call. Time to look at questions submitted by our listeners.
All right, everybody. That music means time for you folks to join us here on the old show. We'll start off. Let's get some of your sentiment in here on your votes on our questions of the week. Last week, we asked you folks, 0 day, clearly popular with our audience out there, especially in the index options category, because that's pretty much the only place they're available right now. But we thought, a lot of you were asking what's coming next. So we thought we'd put it to you. What should be next? Which product or market or complex should list 0 day options next? Gave you 4 different categories. Your single name equity, so your Apples and your Teslas, that sort of thing. We've broken down many times on the network the pros and cons of that. Commodity options, so it could be whatever, your ags, your metals, could be your energy. Pick your poison, whatever floats your boat out there for futures options. Or crypto, your Bitcoins or your ETHs, or the vol space, VIX or VXX, or all those types of products. And Mr. Matt, surprise, surprise, our audience ended up choosing the single name stocks, Apples and Teslas. They won with 43.2%. Right behind it, we had vol coming in at number 2. So they want single day VIX, 29.7%. Not sure if we'll ever see that, but Seaboard has listed a 1 day VIX, so they are at least thinking along those lines. 18.9% for commodity options and 8.1% only for crypto. Mr. Matt, do these results surprise you, or is that kind of in line with how you voted?
Yeah, they don't surprise me. So here's my feeling on that. I worry about single stocks, and I think so does the OCC, the clearing corp. And the reason is because of corporate actions and expirations every day. Early exercise, all that. It's just it just worries me. I just wonder how set up everyone is for that. Like, if there's a dividend and there's an early exercise, and that's happening more and more, it just it just worries me. I don't know if it's a worry that is substantiated, but those worry me. I think they should do more of the ETFs and all that, and single stocks should be late, just to make sure they got all the kinks out. So not surprised. I would have thought volatility would have come in ahead, but it's pretty close, I guess. But that's how I feel about that, Mark.
Yeah, not surprising you folks want yourself some single-day Tesla and Apple. I hear you out there. Got a few obstacles to clear before we get there, but we'll see. Let's go to this week's question of the week, Matt. This is right up your alley, right along the lines of what you were just talking about with your overall bearish sentiment. We thought, we've seen a little red on the screens lately. I'm not sure. We had green earlier, now we're back to red again on the screens again today. So S&P, as we're recording this, listeners, back below the 4,300 level, right around 42.5 as we're recording this again. So giving up roughly 300 handles from the highs around 45.5, just recent highs, not, of course, all-time highs. But intriguing stuff out here. Let's get out to some of your sentiment. We said, we've seen a little red on the screen lately, so it's a good time to come back in and gauge your broad market sentiment. Quite simply, where are you comfortable buying into or buying more if you already have some in your back pocket? Where are you comfortable buying more, averaging back in to SPX right now? And when we posted this, we were north of 4,300. Actually around 43.5, I think, when we posted this. So we've already given up 100 handles from there. But 4,300 to 43.5, so we're right around where we posted it. Or a little lower, 4,200, so below 4,200 actually. Or even lower, so you wait until we break 4,000 before you start buying back in. Or you're coming for beer, you're saying, you know what, I'm loaded for beer, I want this, I want more downside. We're going to go back below our recent lows back from last year. So below the 2022 low, which was a little bit below the 3,600 level. So, Mr. Matt, I know which way you're leaning. You got a big check mark at that, the bottom one there. But if you want to expand on that, have at it. But B, more importantly, which way do you think our audience is going?
I mean, you know me, Mark. I was calling 3,000 before 5,000, so we're getting closer to the middle. I think I don't know. I mean, I think the audience, how are they going to lean? Let me just think here. I mean, the best bet is here, and your audience seems smart. I bet you the fewest is where I am, under 3,600. But so that's how I'm gonna stay. And I bet the audience is here, and below 3,600 is mine.
All right, let's find out. They are the ultimate arbiters of all things at the end of the day, Mr. Matt. And our audience, they're choosing a little lower. They're saying they're not getting back in till below 4,200, Matt. Right now, that's winning the dance with 45.7% of the vote. Even lower, so you're waiting until we're back below 4,000. That's 21.7% of you. Mr. Matt, your 3,000 before 5,000 crowd actually having a fair showing, 19.6%. Coming in third, saying they're waiting till it's back below the 2022 lows of 3,600. So you're not quite as out there as it might sound, Matt. And then bringing up the rear actually is right here, 4,300 to 43.5. Nobody wants that. I think a little bit of recency bias there. They can get it 100 handles lower. But intriguing stuff out there, listeners. You can vote, of course, at Options on Twitter is the place to go to make your voice heard. That will run throughout the rest of the week. We know a lot of you are coming in many months, if not years, down the road. We welcome all of you folks as well. Of course, there will be a different question of the week. That's why you got to follow us at Options. New one every week over there. You folks can chime in and see what the rest of our audience is thinking on a whole variety of fun topics over there. Speaking of your thoughts on a variety of topics, Mr. Matt, we've had an interesting ongoing discussion here. We had an episode a few months back, I think it was back in July, where we kind of broke down the different offerings that are available for options traders in the volatility space, and then some of the strategies that are very popular out there, including a lot of the popular erosion trade that you and I have talked about many times on volatility views, and a lot of people use products like VXX and UVXY and UVIX to try to capture out there. Well, our listeners like that, including this one listener, Theta Noob. He wrote in back earlier this month saying the episode you did back in July about VIX products, that prompted him to look into it a little more, and he decided to test out. He's doing his own little back test, Matt. He's testing a leap put in UVXY and managing with a front expiration short put. So he's actually legging into it wasn't quite a 1 year. I think it was June and January. So it was a little under a year on the longer end of the calendar. And then the short end was a few months out, obviously, on the Jan front. And I think he did it around the 14 strike, wherever UVXY was at the time. And he wanted to ask our thoughts. And we kind of chimed in back then. I kind of told him I'm a little bit more reticent on those strategies than I was in the past. The early days of vol views, you can pick your poison, whatever it was. VXX was the most popular vehicle to do it, but UVXY came on the scene. It was pretty popular, a little less so now because it's been neutered, of course, from a leverage perspective. Now they have UVIX, but there was a very great set it and forget it trade. You buy a 1 year output, usually in the Jan expiration cycle, in any of those. VXX, UVXY, UVIX is a newer addition. So maybe I shouldn't lump that in. That's a more recent addition. But any of those kind of eroding products, and you did pretty well. It was one of the closest things to a set it and forget it trade that I saw out there in the market. And then a couple of things started happening, which made me a little bit more reticent to recommend it to people like Data Noob. Was that people started picking up on this, so that trade started to get a little bit more crowded. The market makers are not idiots. They saw everybody and their mother buying Jan expiration and other longer-term out-of-the-money puts and products like VXX. So they started jacking up the vol. So those puts got more expensive. The profit potential of those trades got a little bit lower. And also, I saw more than a few examples of times when these trades really worked out. And a lot of them were long-term because we would track them on shows like VolViews, when they opened them, when they took them off. And they would put on a put in, let's say, VXX or whatever, UVXY, and it would work out, and those products would erode predictably throughout the year. And then we come out of December, we get into January, and we're coming up on expiration. This trade looks like a home run, and then something crazy happens in January. Could be Putin rolls into Crimea. Look at the just recent history, how many things we've had crazy pop off in January. That pops vol in that month completely destroys any profit on the trade. Sometimes it happens with just a few days to go. I refer to these products now as heartbreakers, and really for that reason, I've seen a lot of OI go to die on the put wings in these names. So that's another reason why I'm a little bit reticent to recommend these longer-term downside trades, because I've seen them go badly right at the tail end. So if you are going to do this, you have to be judicious and probably take it off maybe a little bit before. Might want to hold it on to capture the last, 30 cents or whatever's left of that put, but past his prologue, you want to take it off a little bit earlier. Well, he wrote in to say, thanks for the feedback. Well, first off, we mentioned he should listen to VolViews. He said, I'll only listen to it if Mark Longo is hosting. I can't afford to fall asleep while I'm driving if it's not someone exciting like Mark or Dan. So, well, first off, you'll be good there to noob because I do host VolViews, even though I think all of our shows are exciting. But hey, they're all my children. I can't pick. But he wrote back, Matt, to say, I appreciate your feedback. He ended up punting on the short put, and it's now just a 15-11 put diagonal. He actually had a SEP put. I take it back. He was short a SEP put, so it was he was rolling a weekly or even monthly put out there. He rolled it to Jan, and now it's a 15-11 put diagonal. June, Jan, 15-11 put spread out there. But Matt, I kind of gave my thoughts on this. Let's start there. Where are you on the long-term pick your poison, UVXY, VXX put? Are you a fan? Are you not a fan for the reasons I mentioned? And then B, what about his little upgrade here, the legging into a calendar/diagonal? You like those tweaks?
Yeah. So, the longer term, if you look at you're trying to profit on the roll down. Obviously, if that moves a lot, it's gonna affect you negatively. So, how do you protect yourself? Is kind of the thing that you want to think about. So, to me, I like the put diagonals. I like them more out of the money. This seems a little bit long term to me. And the reason I like the put diagonals in the SPY right now is, I kind of sense the market coming down to it slowly. But if it goes quickly, then you kind of lose you lose the benefit. So, it seemed a little bit odd to me, but I went ahead and back tested these in our ORATS back tester. And the calendar that was described, maybe 100-day at the money and short put, and then a long 300-day, that represents the June at the money. That didn't do very well. It kind of broke even, hung out around there. So that wasn't that good. And then what I did is I did it out of the money. That wasn't that good. But then I just did a longer put and short and out of the money put. And that actually worked decently. But that's almost just like a long put. So, long-term put. So, yeah, I mean, I don't know. I don't know if I'd get that creative with it other than just to, be long a putt and be a little nimble with it is kind of, but again, I don't deal with those complexes that much just because it's a derivative on a derivative, and it just, to me, it gets a little bit difficult to wrap your head around and such. But the back tests, look pretty good. But anyway, and then like I said, I've said on other shows, the people trading those know the ins and outs of all the documentation behind it, and really there's a lot that doesn't meet the eye on some of those options, derivatives of derivatives, and so I tend to stay a little bit farther away from those, Mark.
Yeah, we call them Franken products here on the network for a reason. You're right. The long-term nature is another reason why I was a little bit skittish about this, because it doesn't give you the flexibility of something a little bit nearer date if you need to adjust your strikes because your strike is really no longer relevant. Kind of hard to do if you're sitting on a meaty long-term option out there. So there's a lot of reasons why, was that Theta Noob, why we were a little bit dubious on that. But, you are picking up on what we're putting down. That can be a great trade, that vol negative roll yield out in the vol products out there. You just have to know what you're doing. You really should be able to calculate what the roll impact is going to be, looking at the term structure of the volatility futures and calculating the contango, or if there's in backwardation. That's not going to help that trade, obviously. So if all those terms are foreign to you, then you should not be doing this trade. If you understand all those terms, you can go look at the term structure and kind of calculate what some of the expected roll down should be, the negative roll yield, then this is a good trade for you. Again, a lot of moving parts, a lot of complicated components. If all that's over your head, don't worry about it. You don't have to trade it. But it is an intriguing area of the space. And for a lot of you out there who maybe are just kind of, you want to wash your hands of the vagaries of all the macro nonsense that's going on. You want to focus on just one thing, like the slope of the vol surface and how that's impacting these products from a roll yield perspective. You can just do that and make a decent living at it if you know what you're doing. All right, we've been kind of going on for a while here, Mr. Matt, but we'll get you out of here on this one. This is a fun question, and one I'm sure you're probably thinking of a lot over there at Orats right now. This comes from Harish, maybe Harish. Let's go with Harish. Harish wants to know, does this whole ZeroDTE thing make you rethink the way you approach options trading? So many of the popular strategies were never designed with such a short-term time horizon in mind. And Mr. Matt, you are the poster child for this. Was it the last time you were on with me? Was it on our pro side? It was on Options Oddities, right? Where you hit that jackpot on that fly on the FBX, right? And you went crazy like you hit a lotto on the show, which I get it. You kind of did. So, yeah, you're like the poster child for that. You've really gotten lured to the dark side of zero day. Let's start there. Why are you such a convert? Why do you love the zero day so much? And then Harish wants to know, does it make you rethink the way you approach options trading as a result? Or maybe in your case, also the way you run backtests?
Yeah, it's a good question. I'd question one of the premises. They're not designed for such a short horizon. I mean, some are, some aren't, but everything could be focused. Butterflies, even calendars. One day short-term calendars are can be adapted to the ZeroDTE. Okay. So the ZeroDTE, I guess the reason that so many people are attracted to it is there's such a large amount of liquidity. You get filled, I think, at pretty fair prices. You see what happens pretty quickly. The cash settled. You don't have to worry about early exercises. But they are hard to backtest because there's a lot of nuance, especially during the day when things are flying around. So, I guess it has maybe rethink my approach to option trading because there's a day in and day out, you could I kind of offset my other positions. So as you know, I have these kind of short positions, short put, short delta, for put calendars that I have on longer term put calendars. So those are short deltas. And, I do some things to get long deltas, each day, and sometimes in the 1DTE. So yeah, like I'm using some of the 0DTEs against my position just to not, lose too much on my underlying positions until the market goes my way. So I am rethinking it in that way. And it is, and we've adapted a lot of our systems in order to capture the data for the back testing. So we're putting signals together. We're doing a lot of things that you need to do, because it really is. The way I look at 0DTEs, it's just like regular trading, but it's just focused in a shorter time frame. I think it's very important. I think it's very useful. I think it's actually a benefit for the overall market. I think it actually lowers liquidity. I've been saying that. I mean, lowers volatility and overall market risk because the market makers aren't just leaning all one way because the banks are putting them in a bad situation. So I think it's actually been great for the industry, and like I said, taking some of the volatility out of the market. And yeah, I mean, I think it makes the popular strategies part not being designed. I mean, I think you need to adapt those strategies to a shorter time frame, and they could all work, like shorter calendars, shorter butterfly, shorter verticals. All those can be adapted to a shorter time frame. So it's a good question, and yeah, that's the best I could do on that answer to that, Mark.
Well, Mr. Matt, that music means we've come to the end. Man, we packed a lot of living into the show today, sir. We started off in the bear halls of Germany. Then we got into the old wheel of death. Then we touched on some long-term UVXY put/diagonal/put spreads, and we ended it up on 0DTE. I think we touched on all the hot-button issues in the world of options today, Mr. Matt, so congratulations. Well done, sir.
Yeah, that was a lot of fun. As always, great questions. I did think of another thing for the wheel strategy. One of the things that I do is you want to try to identify stocks that you want to own. So what I do is we have a stock scanner that ties into our option scanner, and that ties and our option scanner does these kind of hard to find diagonals that aren't too wide and that still have a credit for you. So I should mention that I like to find dividend paying, low beta. So it means it doesn't move so much with the market stock. So I just thought of that, and I wanted to get that across to your listeners, Mark.
An important addendum, sir. And if folks want to play around with your tools for themselves, maybe they might have some questions they want to send Otto's way. Where should they go? What should they do, Mr. Matt?
Yeah, orats.com. My email, matt@orats. Feel free to reach out. I mean, we're going to have some exciting stuff, Mark. We have a market intelligence coming out with you could drill down to all the big trades during the day, and you could see the history of it, or the minute-by-minute history of these trades. It's really been fun to test out, so that's going to be our new thing. We're always adding new tools, and that's going to be the latest. We're going to get, before the year's done, 1 billion back tests, so they're pre-canned, so you could just go in and search through them. That's going to be a lot of fun. So there's a ton of stuff over there. orats.com. Always looking for people to come in and kick the tires and let us know how they like the products. And it'd be great to get some of the people from your fine station over there, Mark.
There you go, listeners. If you have questions about all the stuff we were just talking about, maybe you want to back test those UVXY puts yourself, or you want to back test your own wheel of death, or do any of a million, or as Matt puts it, 1 billion potential back tests on whatever strategy floats your boat. One place to go, ORATS, ORATS.com. The place to go. Give Matt a follow on Twitter while you're at it as well. Always tweeting out some interesting factoids and data about the options market. You can find him at Option Rats, all one word, on Twitter. And of course, you know where to go. He's off drinking in Munich right now, but he'll be back next week. And you can hit him up over there with your usual questions and mentoring and all sorts of other fun. Market Taker, 2 T's in a row.com, the place to go for all the goodies Dan's got in store for you. That's going to do it for us on the network today. Back again tomorrow with our doubleheader. We'll be back with the option block with our buddy the Flow Master and our friends from SIBO over there. Then after that, for This Week in Futures Options with our friends over there from CME. Then back again on Friday. If you like all the stuff we were talking about, UVXY puts, VXX, VIX, all that stuff, we have a whole show about that. It's called Volatility Views. It's on every Friday, noon Central, 1 p.m. Eastern. Of course, the live is for the pro folks, which I got so busy at the top of the show I didn't even mention. If you want to get access to all those shows live, get access to the awesome pro Q&As, of which Matt has been on in the past, and others, of course, giveaways, all sorts of fun. We're coming up. Actually, it's the end of the month, so we're coming up on the September Pro Trading Crate giveaway, so get in there. Get your name in the hat. Only one place to do that, theoptionsinsider.com/pro, the place to go to get all that awesome content. And, of course, you should be listening to the full network if you're not already. That's where you're going to get Vol Views. You can find that on any podcast platform under the sun, and a lot that aren't podcast platforms, like Audible or YouTube, or pick your poison out there. If it plays audio, it's probably got our network, so check it out there. Of course, back again throughout the rest of the week with all of our usual array of content. Dan will be back from Munich, sober or not, I don't know. I can't speak to that. But he'll be back on the show next Education Wednesday, another episode of Options Boot Camp. Stay safe out there, everybody.
You're listening to the Options Insider Radio Network, the home of the Options Podcast. For more quality options programs, visit theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app available in the iTunes and Google Play stores. Select programs are also available via live stream at mixlr.com/options-insider. That's mixlr.com/options-insider. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, stocktwits.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.